In every major financial crisis, there's a small group of people who seem to be playing a completely different game. While everyone else celebrates new highs and buys the dip, they quietly head for the exit, buy protection nobody thinks they need, and then somehow end up billions of dollars richer when the system finally cracks. In 1929, a few speculators walked away from the party months before the Great Crash and then made fortunes as stocks fell nearly 90%. In the mid-2000s, a handful of investors digging through boring mortgage data placed huge bets against the housing boom and became legends when the bubble burst. In 2020, during one of the fastest crashes and rebounds in history, a single hedge fund turned a modest insurance trade into billions, then used that cash to buy world-class companies at panic prices. Different decades, different bubbles, different technology. But behind all of them is the same four-stage playbook that shows up whenever markets become wildly overvalued and leverage piles up. Right now in 2025, that playbook is being run again. The largest investors on earth are sitting on record piles of cash. Insiders at some of the most valuable companies alive are selling tens of billions in stock, and sophisticated players are putting on trades that only pay off if something breaks. Most people just see green charts and new highs and assume the worst is behind us. But the investors who have survived the last century of crises are behaving as if we're at a very specific point in the cycle. In this video, we'll break down that four-stage pattern, how it worked in past crashes, where the smart money is positioning today, and what all this means for anyone trying to protect and grow their savings in the next 15 to 20 minutes of your attention. If you zoom out over the last 100 years of markets, a pattern starts to emerge beneath the noise of individual crises. In the late 1920s, the roaring 20s felt unstoppable. Radio, cars, electricity, and easy credit created an illusion of permanent prosperity, while margin loans let people buy stocks with borrowed money they could never repay if prices dipped. In the late 1990s, the dot-com boom replayed the same emotions with different assets. Unprofitable internet companies with no clear path to earnings were valued higher than century-old industrial giants, and eyeballs replaced profits as the metric that mattered. In the 2000s, the bubble shifted into houses. Cheap credit and loose lending standards turned real estate into a speculative casino, with banks packaging risky mortgages into complex securities that looked safe on the surface. Outside the US, Japan's late 1980s bubble pumped property and stocks to such extremes that the land under Tokyo's Imperial Palace was once said to be worth more than all the real estate in California, while parts of Europe binged on cheap credit and construction before 2008. More recently, a decade of ultra-low interest rates pushed investors into anything that promised extra yield: speculative tech, junk debt, crypto, meme stocks. In each era, the details changed: tulips, railroads, dot-coms, houses, AI. But the structure stayed the same. Prices detached from underlying cash flows, leverage soared, and ordinary investors arrived late, chasing stories of easy wealth. Beneath all that excitement, a small minority consistently did something different. They watched balance sheets instead of headlines, leverage instead of hype, and asked not, "How high can this go, AZ?" but "What happens if this stops?" That mindset is the foundation of the four-stage pattern we're about to break down. To understand how the same minority keeps winning the same game, you have to stop thinking in terms of single events and start thinking in terms of sequence. Because what looks like chaos on the surface often follows a surprisingly clean four-stage cycle. Stage one is leave the party early. When valuations stretch far beyond historical norms, leverage is everywhere, and the reward for taking risk no longer justifies the downside. Experienced investors quietly trim positions, reduce exposure to crowded trades, and build cash without trying to guess the exact day of a crash. Stage two is buy insurance before anyone thinks they need it. With some chips already off the table, they spend a small but deliberate portion of their capital on protection, put options, volatility bets, credit default swaps that will explode in value if the system wobbles, even though those hedges may lose money month after month while prices grind higher. Stage 3 is target the weak links. Once stress becomes visible through rising defaults, disappointing earnings, or failing lenders, they stop thinking about the market and start focusing on pressure points, sectors and institutions that simply cannot survive if conditions stay tight, and short those specific names or instruments instead of betting blindly against everything. Stage 4 is buy when it feels unthinkable. When indexes are down 40 to 60%, news feeds are filled with layoffs and bank failures, and ordinary investors swear they will never touch stocks again. The same people who left early and profited from protection use their cash and hedge profits to buy strong businesses and real assets at fire sale prices. The tools change with every era, but the sequence: exit early, insure, aim at structural fragilities, then deploy capital boldly at maximum fear, has repeated so often that it's less a theory and more a recurring blueprint of how disciplined capital behaves through boom and bust. Case study 1929, 2008, 2020. You can see this 4-stage skeleton clearly in 3 very different crises. In the late 1920s, as Wall Street offices filled with margin-driven speculation, a handful of operators studied the explosion in borrowed money and concluded that even a modest decline would trigger forced selling on a massive scale. They spent the summer of 1929 scaling back their long positions, stage 1, then built short positions in the frothiest stocks in stage 2 and 3, and after an 89% peak to trough collapse, used their cash and profits to buy stocks, businesses, and real estate at depression level prices, stage 4. In the 2000s, a few investors dug into the loan tapes behind mortgage securities and realized much of the housing boom was built on borrowers who couldn't afford resets. They exited anything tied to the housing complex, stage 1, helped create and then bought credit default swaps on the worst mortgage bonds, stage 2, targeted the ugliest slices and most exposed banks, stage 3, and when the system imploded in 2007, 2008, those hedges paid out billions that could then be deployed into distressed but fundamentally sound assets, stage 4. In 2020, after a decade-long bull market fueled by ultra-low rates, some funds were already cautious and partially de-risked before the pandemic headlines turned apocalyptic, stage 1, layered on credit and equity hedges as the virus spread. Stage 2 harvested enormous gains from those hedges during the fastest crash in modern history, a compressed stage 3, and then right in the middle of the fear and lockdowns, used that cash to buy high-quality franchises that went on to rebound violently. When unprecedented stimulus hit, stage 4, different stories, same choreography, step away, insure, target weakness, then buy when everyone else is exhausted. Hien, Tai 2025. So what does this pattern resemble in 2025? On the surface, many major indexes are near highs, powered heavily by a narrow group of mega cap tech and AI names. But under the surface, some of the most informed actors are behaving exactly like late cycle participants in earlier eras. One of the world's most conservative and successful investors is sitting on a record cash hoard in short-term government paper and has been a net seller of stocks for multiple quarters, effectively choosing patience over chasing another leg up, a classic stage 1 decision. Corporate insiders, CEOs, CFOs, and directors who see real earnings, order books, and risks before the public does have been selling stock at a pace comparable to prior market tops, indicating that the people closest to the numbers don't believe current valuations are sustainable. At the macro level, long-term valuation gauges like market cap to GDP are deeply into historically overvalued territory, implying that future returns from these levels are likely to be lower and more fragile. At the same time, slow moving fault lines are widening. Commercial office buildings in major cities are sitting partially empty in a world of remote and hybrid work. Many were financed at ultra low rates that are now resetting higher, and a large chunk of that debt sits on the balance sheets of regional banks that have already shown vulnerability in recent failures. The result is an environment where cash and caution at the top, quiet hedging in options and credit markets, and rising pressure in specific sectors all point to something between late stage 2 and stage 3. The exits have been used by those willing to be early. Insurance is being bought in size, and the weak links, over-leveraged real estate and certain lenders, are already under growing stress, even as retail investors remain focused on headline highs and AI narratives. Looking ahead, the honest way to think about the next few years is not with one bold prediction, but through a few realistic scenarios that map onto the 4-stage pattern. In a hard landing, some combination of commercial real estate defaults, bank stress, overvalued tech repricing, or geopolitical shock could push markets into a 40-60% drawdown. Credit conditions would tighten sharply, unemployment would rise, media coverage would turn apocalyptic, and stage 4 would appear in its purest form as prepared investors use their dry powder to buy quality assets at panic prices, while those who went into the downturn fully leveraged are forced sellers in a slow squeeze. There is no single crash day, but sticky inflation and the higher for longer rates grind down profit margins. Overhyped growth stories deflate, and real returns stay weak for years, rewarding those who insisted on sensible valuations and strong balance sheets, and allowing stage 4 to show up as a series of smaller, sector-specific bargains rather than one giant bottom. In a volatile reset, markets swing violently between fear and relief. Sharp 20-30% drops followed by explosive rallies as policymakers toggle between tightening and rescue, a pattern that punishes investors who chase each narrative and rewards those who keep some cash. Use hedges selectively, avoid structurally fragile sectors, and treat repeated pockets of panic as multiple mini stage 4 moments. Across all 3 paths, the core distinction is the same. Not who can guess the exact trigger, but who structures their finances so they are never forced to sell at the worst moment and always have some capacity to buy when prices disconnect from long-term reality. Strip away all the noise, and the 4-stage pattern is less a secret hedge fund trick and more a disciplined way of refusing to move in sync with the loudest emotions in the room. Leave when others can't imagine leaving. Protect when others mock the idea of risk. Aim carefully at genuine structural weaknesses instead of shorting everything, and then be willing to buy when fear has driven prices far below what solid businesses and real assets are truly worth. History doesn't repeat exactly. Regulations change, tools evolve, and the logos on skyscrapers are different, but human nature barely moves at all. And the mix of greed, FOMO, denial, and panic that fueled 1929, 2000, 2008, and 2020 is clearly visible again in 2025. You don't control which stage the global system is in, but you do control whether you behave like the exhausted crowd that buys late and sells in despair, or like the small minority that treats every boom as a test of discipline and every bust as an opportunity prepared in advance. If this 4-stage script is even half right, the question isn't whether there will be another brutal phase in the cycle. History says there will, but whether when it arrives, you'll be among those forced to dump assets just to survive, or among those holding cash, a watch list, and enough courage to act when everyone else is paralyzed.